Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
All right, everyone, how you going? Thanks for joining us on the podcast. I hope you're enjoying the diversity of guests that we've been having over the last couple of weeks as we kick off into 2020. We're really putting our backs behind getting a whole bunch of different voices onto the podcast, and you'll see a lot of this moving forward as we go through 2020. Property investment obviously covers a whole bunch of different areas from the investors themselves, and we love telling those stories of people out there investing in property, creating wealth, and hopefully giving themselves some freedom for a better retirement. But there's a whole bunch of moving parts to property investment, and there's a lot of professionals in this space, ranging from our accountants to our mortgage brokers to our buyers agents to all other related people who are supporting property investors. There's also the mechanics of being a property investor and your responsibilities of a property investor, and one of those is how you have a relationship with the Australian Tax Office, the ATO. And for a lot of people, the acronym ATO might make them shudder a little bit. For a lot of the people, they have a great relationship with the ATO and understand and appreciate the great work that the ATO does in supporting Australia and making sure we can progress as a nation. I want to have a chat about this today, and I've asked someone from the ATO, senior person from the ATO, to come in to the studio to chat all things tax, what 2020 might look like, what you may need to upskill your education around, and how you can ensure that your relationship with the tax office is as positive as possible. Adam O'Grady, Acting Assistant Commissioner, Individuals and Intermediaries at the ATO. Adam, how you going, mate? Thanks for coming up from Adelaide for this.
Yeah, thanks, Phil. Really excited to be here and looking forward to the opportunity to talk to you and your listeners about all things tax and property investment.
We love all things tax and property investment here. I think most people love more things property investment rather than tax, and I think tax for a lot of people might be an afterthought when it comes to investing in property, and they probably need to pull it a little bit further up in their importance level. And myself and my journey through property investment has been one of these where I've thought more about the buying and the investing rather than the architecture and infrastructure of how I do that. So I think I really want to put some importance onto that today, and we can have a discussion around it. But before we do so, right now we're recording in North Sydney. I can't see out the window because it's bucketing and belting with rain, which everyone has been waiting a long time for. But hopefully it's going to put some of those fires out, which have been raging for the last couple of months. But I know a lot of Australians are out there hurting, and there's a lot of people who are property investors who may have been impacted by the bushfires. What's the best way for them to look at what's going on at the moment, and what's the tips from the ATO around that?
Look, Phil, the first thing I'd say to anyone that's been impacted by the fires or recent disasters is tax doesn't need to be the priority right now. They need to look after themselves, their family, and sort through that situation. So what we've done is, across all those impacted postcodes, we've granted deferrals for things like their activity statements or lodgements, debt recovery and what have you, so that people can just take a breath, worry about what's important, and then come and catch up on their taxes later on.
So that can be sorted out in the wash once they just get everything else sort of moving forward.
That's right. So it really just gives them the next couple of months to sort of settle things down, work out what's really important, and then they can come up and talk to us, catch up on whatever lodgements or debt payments they need to make. And we've got a heap of information on our website around disaster recovery, around what we're offering to them. The other thing I'd say to anyone that's been directly impacted, when you're ready to talk tax or you've got those obligations, come and talk to us. Come and explain your situation. Wherever we can, we will help people out to get back on their feet and get over these huge disasters which have impacted the community.
So I think the overall philosophy with that is that if you're unsure or you don't know, just get in touch with you guys, give a call. You're better off. Don't sort of try and hide from anything which might be a problem. Actually be transparent, and then stuff can happen.
Yeah,
I don't think the ATO is very accommodating if you actually reach out to them.
Yeah, exactly. I think the worst thing anyone can do is sort of ignore the problem, like the problem won't go away. But coming and talk to us, explaining your situation, and we'll work with people to come up with something that helps them and ultimately helps them get back on track.
That's good. And if you're still concerned around all that, I'd also recommend speak to your accountant. Your accountant will know what to do as well. So get on the front foot if you are impacted and affected, and hopefully it'll be a much better outcome for you, or maybe remove some of the stresses associated with it. So let's talk investment properties in Australia and sort of how it registers on the scale. I know it's a big driver of revenue for the ATO, but a lot of people are unsure about what they need to do in terms of being a property investor in Australia. Can you give me some sense of how big the property investment space in Australia? And I know you sort of measure it on, and the ATO is pretty much one of the key sources of actually understanding how many property investors there are in Australia, because you get people's tax returns. So if someone ticks a box, they're a property investor. How big is it?
Well, across the country, we've got about 2.2 million individuals are invested in property, and that's increasing each year. And it's been a steady increase along that time. So it increases by about 2 or 3% every year. So more and more people want to get into the property investment market. They see a huge opportunity there. As far as the actual dollars or the scale, the economy that goes through that system, it's around $46 billion of rental income and $50 billion worth of expenses. So you can see to the economy, to the country, it's a huge market for us. It's a huge opportunity. With our individuals, most are single property owners. So around 70% of our client base has one property. So the traditional situation is they've paid off a big part of their primary mortgage and are looking for an investment opportunity. They purchase another property. In that vein, as I mentioned, $50 billion of expenses against the $46 billion of income. So it's a negatively geared system. We've got more expenses than we do income. And around 2/3 of property investors are in fact negatively geared. So it's around 61% of all property investors negatively gear their property, which can sometimes be a bit of a scary concept or people don't really understand what that means. It's very simply their expenses are in excess of the income they're earning is simply what negatively gearing refers to.
And this is quite unique to the Australian system, and I know you can't talk politics, so I won't go there, but I think this is just my narrative of that. I think this is a realisation when we went through the elections last year of just how big this cadre of property investors are in Australia and the volume of businesses, and put inverted commas, that flows through it. So it is a critical part of the nation's economy. But when you step outside of the mechanics of that, this is 2.2 million individuals who are contributing to other Australians to have a place to live. And this is one of the things that attracts people to property investment. But when you sit around with your colleagues within the ATO and you look at sort of, I think you said 70% of most property investors only own one property, do you sort of sit there and go, a lot of these people probably shouldn't really be investing in property because it might not be right for them and might not have the sophistication for it. They might not be aware of their understandings, because for many people, this is their way to create wealth. Right. But there must be better ways to do it. So if you're one of those people and you think you invest in property, or you listen to this podcast and you're one of those 70% of people, how can they do this better, do you reckon, property investing, considering their tax sort of obligations?
Yeah, look, I think the biggest thing we find in this market is there can be complexity to the system. The tax system can be complex, and particularly complex if you don't think about tax up front. So what we find when we review people, talk to people about their affairs, tax has been an afterthought in when they're setting up their investment. So people are very good at looking at where's the best suburb to buy, where am I going to get capital growth, what sort of rental returns will I get, but they don't really talk about the tax obligations or think about what those tax obligations are, whether that's talking to their accountant to understand what they should be thinking of, or using our own website to look at some of the guidance and advice we give them. And one of the real examples of that in recent time has been the short-term accommodation platforms, where you can now rent out your house for 2 or 3 weeks when you go away, or you can rent out a room. That's all income that needs to be taxed. You need to report that through the tax system. But a lot of people have jumped onto that as a way of earning extra income and didn't really consider the tax implications of doing that. Because not only is the income component, but it changes capital gains treatment of the property as well. So really my biggest advice to all the investors listening, particularly those that maybe are just starting out, is make sure you have an understanding of what the tax obligations are, and in particular keep all your records. That's one of the biggest issues we find, is people just don't keep records of what's happened and why and when, receipts, all those things. That's really critical for you to understand and meet your obligations through the tax system.
And that's the responsibilities of being a property investor as well. You can't get all the good stuff and all the benefits of being a property investor, wealth creation, all this sort of stuff, right? You've actually, if you want to play in this game, you've got to play it right. And I think that's where a lot of Australian investors probably get it wrong. So the message I'm getting from you, and I could probably do a bit more of a different narrative than what you can, is about you need to disclose this stuff, right? Yep. Like always disclose. And if you disclose, it means you've got understanding of what's happening, and then you can therefore best treat a particular circumstance or situation. Now, a lot of people think it's their accountant's job to do that disclosure, but you need to actually tell your accountant what you're doing, because if you're not doing that, they can only act on the information they have.
Yeah, exactly right. Your accountant's only as good as the information you provide them. So, the accountants out there are highly skilled. They understand the tax law. They can really help you make sure you're structured in the right way and help you set up the proper recording requirements and all those sort of things. But they can only do that if you're open and honest with them. You need to talk to your accountant, explain what you've done, why you've done it, how you've set it up, and then they can give you that right advice. But yeah, you don't tell the accountant that they're not giving you the advice you need.
They just don't know. And again, I'm fortunate. I have a privilege. I speak to property investors all the time right across Australia. And, the conversation I normally have with them is about all the cool stuff. Where should I buy? Who should I buy with, etc. No one really comes to me and goes, "Oh, Phil, I love doing my tax. It's the best part of what." To be fair, some people do, they absolutely obsessed with it, but most people outsource the management of their portfolio to a tax agent or an accountant, and I think that's a great way to go through it. And if you're not doing that, you should consider it, because you may be missing out on some of the strategies and structures to better run your property portfolio, but you've got to tell your accountant what's going on. So if people take that away from this conversation today, I think we'll be doing pretty well. And other point I think from this is that, mate, put tax first, really. Don't invest around the wrong way. And you've got lots of resources on your website in order to do that. But where would you start? So let's just say, as a bit of a case study, I'm thinking of investing in property. What do I do when it comes to the taxation component of it?
I think the first thing for anyone looking at those investments and thinking about tax is jump on the website. There's a couple of really good products where we've got just simple fact sheets, which to give people a bit of a sense of the sort of things they need to be looking at, and it just uses plain English. It's not all the legal ins and outs, but it gives people a sense of what they should be looking at, what they should be considering as they go through. There's also some videos on there. It might not be the best blockbuster just released from Hollywood, but they're a really good product for people to sit down, watch our videos that actually explain things around your interest expenses and when you can claim them, what you need to do when doing that, reporting your income, all those sort of things in just simple language that people can look at, get a feel for what they might need to do. And that's when they can start making some decisions around, do I feel equipped myself to do this? So can I go away and look at it in more detail to understand what I need to do and set up, self-report and do all that sort of things? Or do I want to go and engage a tax agent or go back to my agent and talk to them? But my first tip is go have a look at some of those products on our website and just get for a feel of some of the issues you need to consider when you're investing.
So I want to have a chat into some of these sort of more deeper technical sides of things. But before I do, I'm just quite interested on the ATO's philosophy towards its relationship with property investors. Is the view that it's the ATO's job to get a better outcome is this education and information rather than sort of uncovering and sort of hunting down people who might be doing things inappropriately? So is the view that Australians by and large want to do it right? They just need to potentially work out how to do it more effectively.
Yeah, and that's certainly our experience. So 2.2 million individuals, I don't want to have to go out and audit 2.2 million people. The department would have to be a lot bigger for me to do that.
Yeah.
But what we find when we do review returns and audit people is more often than not, it's a simple mistake or it's a lack of understanding of what they're allowed to do or what they're not allowed to do. The vast majority of people don't deliberately go out to claim things they shouldn't or obtain refunds they shouldn't. Those that do finish up in front of the courts and prison and those sort of things.
Well, there's some big cases recently around this, right?
Yeah, look, there certainly has. There's a case quite well publicised late last year, and someone who is flipping properties and not reporting GST correctly and driving refunds that they weren't entitled to. So for those sort of people, yeah, certainly we take a pretty
And they're in big house now for that, right? They actually got a conviction around that.
Yeah. So serious consequences for those people.
Absolutely.
However, that's not the majority of people. So the majority of people, they want to try and do the right thing. It's really that lack of education, that lack of understanding. So what we hear stories of when we sort of audit, they rocked up to the accountant and said, oh, here's my income from the real estate agent, here's my loan statements. Oh, I don't know about the rest of the expenses, and just sort of scribble it down on a notepad and paper and say, oh, look, that's about what I think.
What it is.
And it's those situations where they get themselves in all sorts of problems. That's why we're so keen on, talking to the group today to try and spread that education message that there is resources. We want people to get what they're entitled to. So we talk about negative gearing. We want them to claim the expenses they're entitled to claim, but we want them to do it in the right way.
And I think it comes back to your point around just document it, keep the receipts, keep the evidence. And myself invest property, and we share our own journey on the Smart Property Investment, so investing in property. And you sometimes think, I'll sort that out later when it gets towards tax. But when you actually get there, you go, oh, what actually happened? So the best tactic that I've pulled out of it is that do it when you do it, like document it when you do it. It only takes a little while, but at least you've got the record then and file it at that point in time. So when you get to tax time, it's so much easier to work it out rather than going through emails or trying to flick through receipts or whatever else. The time to do it is now, not later.
Yeah, exactly. There's nothing worse than getting the shoebox of Bunnings receipts and trying to work out which expenses were for which property and was it for the house or was it for you're never going to win.
Yeah, it's hard work and you dread it, and it's not a soul destroying job, but it's not something that I imagine people want to do on their night sort of at home. But anyway, so I want to dig down into some of these intricacies of the taxation component of investing in property, but I just want to go to a break beforehand. Back in a moment.
If you're a regular listener to the Smart Property Investment Show, then odds are you're already a property fanatic who loves hearing stories on investing from real people, the good, the bad and the ugly. Be with people just like you and join the group Passionate Property Investors on Facebook now. Become part of a community who know what to do and when to do it. And the time to do it is now. Passionate Property Investors. Tribe, tools and tips. Find us on Facebook today.
Welcome back, everyone. I'm here with Adam O'Grady, Acting Assistant Commissioner, Individuals and Intermediaries at the Australian Taxation Office. We've actually been chatting about the ATI's view towards property investment. I think is a very positive one. It's all around disclosure and transparency and working with them to ensure that your taxation matters are as effective as possible. You spoke really briefly, I want to pick on this point, the short-term rental market. So there isn't now a considerable amount of data matching around that. So because everything is done in the cloud, there's obviously, the records associated with the ATO can now access and map people's tax returns against. Is that like a reasonably new thing that you now have those capabilities? And, where do most Australians sort of get it wrong? Is it like it's only for a week, so it doesn't really matter that much type of attitude?
Yeah, so with the sharing economy, online platforms, that is a brand new program for us. So it's obviously been building in popularity over the last few years. Last calendar year, for the first time, we actually collected data off a lot of these platforms so we can see who rented their property out, for how long, what sort of income they earned from it. And we're working through that data and comparing that to tax returns to understand people that haven't reported that income or haven't reported the full amount, all those sort of things. And it goes back to my earlier comment. Largely it's because people haven't considered the tax obligations of doing that. For sharing economy, it was really sold as a way of making some quick extra cash. If you've got a spare room and the house or the apartment, rent it out to someone, get a little bit of extra cash each week, everyone's sort of happy. Increasingly, what we've been trying to do at the ATO is actually educate people that by doing the tax obligations on the property and the income you're earning, but it changes capital gains exemptions for main residents, all those sort of things. So what we've been doing with the data we've acquired recently is actually writing to people and giving them really an opportunity to self-correct their own return. It's more in that trying to educate people that we can see you've got this income, you need to go and fix up your own affairs. And from this point forward, make sure you're reporting correctly. Really, that's our driver. It's a way of us identifying who's participating in this market and how we can educate them. On top of that, we will use the data to audit people. So those, and we do have some examples where people are on these platforms renting out, 10, 20, 30 properties or rooms across various properties and not reporting on their tax obligations. So for those people, again, we'll take a pretty firm stance on those.
Different levels of this. There's people who are actively manipulating the systems, and then there's those who I think is the majority who are just unaware of what these requirements are. So again, I work around property a lot, so that makes sense to me. But I think what you just mentioned probably could confuse a lot of people. So they probably need to start with their accountant. And again, it's around disclosure. But imagine it works both ways, right? Because if you're recording and registering income around renting out a room or your house for a particular time, that means that it is an investment property as well as potentially a principal place of residence, which has complications. But it means that you would be able to have some deductions as a result of that, because for the portion of the time it is an investment property that you get some benefit from.
Yeah, no, exactly right. So all the normal expenses with owning a property, you can claim an apportioned amount for that income. So your rates, your mortgage, all those sort of things based on how much you actually rent out either the house or the room or what have you. Again, it can get pretty complicated and a bit mathematical.
Yes, it can do.
But there's the two sides of the equation there.
So that's one strategy for some property investors, and they may buy and invest in property for the purpose of investment, and then it's just short-term rental market. And there's now companies that can manage them for you and do all this sort of stuff. Or it might be a bit of a hybrid where they spend 6 months in Australia and then 6 months elsewhere, and for that 6 months in investment property. So that's one strategy for property investors, and we chat about this a lot, Adam, on the Smart Property Investment Show. But one of these other strategies for property investors is flipping properties, so buying, selling, and that cycle. And for some people, it might be buy it, fix it, sell it. It might be buy it, fix it, rent it for a period of time, sell it. It might be buy it, move into it, and fix it while you're living there, and then move on. So there's different parts of this, right? But, what should people who buy and sell or flip properties regularly be aware of? Again, it's a question for your accountant, but top line, what are those key things?
Yeah, so the thing for people who are flipping properties on a regular basis, what they need to be aware of is doing it on a regular or recurring basis. So, some of the examples of a builder moving into a property with the family, renovating the property, and then moving out, doing it to the next property and making regular gains on the property, you could actually be considered to be in the business of flipping property.
Okay.
Which means some of the exemptions that would apply to you as an individual when you normally purchase your home and sell your home no longer applies in that circumstance. And there can be GST implications, income implications as well. So again, it's one of those things that you need to just look at what is it you're actually doing. If you're going to be doing this regularly, think it might be a regular thing. Even if it's the first time doing it, talk to your accountant, come and talk to the ATO around what you're doing, what your structure is, and get that really good advice up front about what you need to consider and whether or not you are actually running a business, even though you may not realise that.
Is there a clear definition when you turn from being a property investor into the business of being a property investor?
Unfortunately, no. There's no bright line test that says...
There's an area of grey where,
Yeah, it really does matter. It depends on how you're sort of conducting the affairs or what sort of effort you're putting into it, all those sort of things. Again, there's some really good source material on the website that sort of tries to...
ato.gov.au. Yeah, okay.
They try and guide people, but it's, again, tax can be complicated, and that's one of those ones which, depending on the circumstance, you can be either way.
So are you one of those people that love like the intricacies of tax and the mechanics of tax? Like, when you wake up in the morning, you're thinking, "Wow, that's a," are you one of those guys?
I don't know that I'm one of those guys.
Some people really love it, right? Yeah. So are you more of the utility of tax and how it's sort of, how it's used in the system sort of thing?
So I think for me, I want the tax system to be as simple as possible.
Yeah.
The reality of the world we live in is the world is complex, and no matter how clear we try and make it, everyone's circumstance is a little bit different. And the tax system ultimately is interacting with human behaviour every time.
Yeah.
So you can't have black and white rules in a tax system which says, if your name's Adam, this is the result. If your name's Phil, this is the result. It just doesn't work like that. It really is a case of, look, this is the intent. The intent is everyone contributes to society. That's what tax is there for, and you all contribute based on the means that you've got, based on your income. So it's that grading scale as much as possible. I want to try and make it as simple as I can for people within what is a relatively complex system.
It can be. And I guess to this point around, if you're flipping properties or your strategies around, doing short-term rentals and stuff, if you're unsure, just ask the question.
Yep.
That's a guiding light. It's a guiding principle for me. I'm always unsure. I speak to my accountant, right? As the best way to start. But there is, this set of rules or principles put in place that everyone fits within, and it's like a fingerprint, right? No one's tax situation is the same as someone else's. They're all individual. But laws are always changing or evolving in line with whether or not the decisions of the people in power in Canberra or making, or whether it's related to, regulatory bodies sort of making recommendations. So this all shapes the tax regime. But what are the sort of some of those key changes in the laws recently that investors should most be aware of?
Yeah, look, there's a couple of changes which happened a few years ago, but we still see people a little bit unaware of what those changes are. So one from 2017 is a change to depreciation. So where you've bought a second-hand property and it's got things like a hot water heater or a dishwasher included in the property, you can no longer claim depreciation on those bits of equipment. They just form part of your cost base for CGT. So that's a change for what people need to consider if you've purchased a property since that date. Unfortunately, what we see is quantity surveyors still include that information in a depreciation schedule.
Okay.
So, they, again, haven't necessarily caught up with our changes. So they've included those in. So it's something for the individual to be aware of. There has been a law change in what you can claim for depreciation there. The other big change has been around travel expenses. So again, since 2017, you can no longer claim travel to your rental property to inspect it or collect rent, all those sort of things. So it's no longer a deductible expense. Unfortunately, people may have been doing that for years and years and years and just haven't caught up with that change, haven't realised that change. So that's the two most recent changes people need to consider there. The other change, which is coming, particularly important for people who are thinking about their tax return coming up in July this year, is on vacant land. Yeah. So for vacant land, so this is where you've owned a parcel of land and you may have intention to build an investment property or something like that in the future. The laws changed recently, so you can no longer claim the expenses on that land. It doesn't apply to people in a primary production type setting, but up until now, if you had a piece of land, your intention was to put a property on it, you were allowed to claim some of the expenses, so the rates and interest expenses. That's no longer allowable deduction from this year.
We'll keep going through all this, Adam, and I'm really interested in it because I know there's some other changes as well, but I just want to stop for this moment before we go to a break and just let you know that Adam's going to come back into the studio at a point in time, and the idea of that's going to be for us to actually answer some of your questions, our listeners' questions around some of these things we're chatting about. So this is a direct channel into having some discussions and asking all those questions you wanted to know about taxation and what the ATO is up to. All you need to do, wherever you're listening to this right now, and particularly on the website smartpropertyinvestment.com.au, just press the start recording button and you can record a message for us and we'll play that out live on air and we'll have Adam in and we'll get them answered for you. We can get really specific if you like or more general if that's what you want. So just click on the button that says start recording, send us that message. If you want to do a little bit more of the old-fashioned way and send us an email, the email is editor@smartpropertyinvestment.com.au. We'll do that in about a month or so's time and we'll put all those questions together and have those discussions and get them answered, because I know this is probably where we get most of our questions. So if we've dialed straight into the tax office, we can hear it directly from that particular body. We're going to go to a quick break. We'll be back in a moment.
At Passionate Property Investors, we hear from a lot of infinite learners who love to know more and share more about their property knowledge and investment journey. If this sounds like you and you want to get more education where your eyeballs are, then join us on Facebook at Passionate Property Investors. Videos, ebooks and learning pathways to get your property cup filled up. Not to mention free education with a tribe who gets it. Join today by searching Passionate Property Investors on Facebook.
Welcome back, everyone. Here with Adam O'Grady. We're chatting tax. He's the Acting Assistant Commissioner, Individuals and Intermediaries at the Australian Tax Office. Now, Adam, before we went to the break, we spoke about you coming on and answering some of those questions. So thanks so much for doing that for us. And I think even though we come from very different parts of this property investment sector, we have the sort of common objective is having more informed and educated property investors that can do this as best as they possibly can. We spoke about some of those changes coming into the future. There's also some potential change around capital gains tax, etc. Just before we do that, can you sort of explain, and I'm interested in this, what is the process for making changes to the tax structure when it comes to property investors? It must start at an idea somewhere that gets debated, but then how does it actually be sort of turned into legislation?
So largely all the tax law is determined by the Treasury Department. So within the department itself, that's the policy body for tax law. Within the ATO, we don't make policy, we simply administer the law as set down by the Parliament. So largely it's a process within Treasury, within the government of the day, to look at the system and obviously make recommendations, make suggested law changes and go through that way. Our role in that is really to provide advice to government on how we may administer a proposed new law, but we don't actually make or recommend those laws, all those sort of things.
So that decision maker's there, then it comes to you, it's your job to administer it, to form and educate, disseminate, and then ensure that it's part of the process for people to do their tax returns.
Exactly right.
Yeah, that's pretty clear. So I know a lot of people have asked me that before, how it works. So it's great to hear exactly how that happens. So changes to CGT or any changes into the future that property investors need to be aware of?
Yeah, there's one big change I think for some of your listeners to be aware of, and that's around the main residence exemption for foreign residents. So under the tax system, your residency status is different to your citizenship and so forth. So what investors need to consider here is if you're here in Australia with your home and then you decide to move overseas for a period of time and you sell that home, you'll no longer be able to claim the main residence exemption going forward. So that main residence exemption for most homes at the moment means you pay no CGT on that. The laws change so that where you've moved overseas permanently, which means you're no longer a resident for tax, you'll now pay capital gains on that property. So it's really important that people who are moving overseas or thinking about moving overseas, maybe have done recently, they really consider when they're selling their property. For most individuals, they've got until 30 June this year to sell their property if they are in that situation and still avail themselves of that exemption. Otherwise, the exemption won't apply going forward.
So if that sounds like you, I'd probably suggest speaking to your accountant to make sure they're right across it, and might change some of their decision-making in how they hold property or when they might choose to sell property. Again, it's one of those more complicated parts of the tax system. So if you're unsure, your best point of action is your accountant, or just give the ATO a call. So let's get into some sort of practical stuff. What are the most common things people get wrong when it comes to the taxation component of investing in property? I know there'd be some headlines that are probably easy to inform themselves around and takes action on. What would they be, Adam?
Yeah, look, there's a few, Phil. So one is interest. So most properties have finance over them, and your interest expenses are a claimable expense. So the $50 billion figure of expenses, almost half of that is made up of interest. So it's a huge amount. What we see, though, is people mixing their investment loan with personal or private expenses. So the common scenario we see is they want to take the family away on a holiday and they're able to redraw from the investment loan. So they might redraw $20,000, take the holiday. But what they've done by doing that is they've actually changed the nature of the loan. So it means that that entire loan is no longer deductible. That is now a portion of the interest expenses from that loan. Also, as part of that, you can't just repay the $20,000 and say, well, I've repaid it, I'll now claim the whole expense again. It's all a portion. So before you go to redraw on a loan or refinance a loan, particularly where there's a private expenditure, holiday, home, might be renovations to your primary residence, any of those sort of things, really think carefully about what that will do to your investment loan, because it will change what you're allowed to claim and what you're not allowed to claim. One of the other things in the interest world is people have their main house and, they're new to investing, they've almost paid their mortgage off and they've decided to buy another property which they're going to move into. They purchase that property and move in and then decide to rent out what was their house. The interest or the loan that you've just taken out for the new property is not claimable because it's your own house. You can't sort of transfer the loans between properties and those sort of things. So it's been really clear what the loan's for. Again, your evidence of what you can claim and what you can't.
And again, I think it's probably a thing to get your accountant right across and, to dispel probably what a lot of people think that, they might get a redraw facility or they might have an offset account that they've got money holding against. That might be a good utility from a cash flow perspective, but that doesn't necessarily say just because you have debt associated with an investment property that's all, taxed at the same rate. I think for a lot of people, they'll be, wow, because I imagine a lot of people probably do that and they're not aware of it. So it's a really good point. And
I think it's a really good illustration of what we mentioned right at the start, is that people set up their investment around, creating returns and ease and, these redraw facilities because they can see the advantages of doing that for their lifestyle, but don't necessarily consider the tax implications of setting up in such a way or having that facility and how they may use it. So it's, when you're making those decisions, bringing the tax lens over what you're doing up front so you really understand if you do this, how could it change the tax treatment down the track.
And it's a good thing for property investors and all Australians in many ways is that our banks and mortgage lenders have become a lot more innovative in the way in which they package up financial products. And one of them is offsets and redraws and lines of credits, and which is good from a minimising the interest you pay component. But there is always that taxation component, this marriage together that people sort of don't ever think about it.
No.
So I might even get you to write a piece for us on smart property investment around this, or have someone from your team so we actually document this, because I know it's on the ATO site, but I think that would be really, really worthwhile. Anything else in terms of, shared ownership? Is that an important part as well?
Yeah, so it's important where a property is shared ownership, and if it's a couple situation, generally speaking, it's a 50-50 percentage split is the ownership. But it's important for people to make sure they're reporting the income and expenses in line with that ownership. So you can't choose to change who claims what income or what expenses, and you certainly can't change it year on year or some of those things which we see. So if you've got $40,000 worth of expenses and it's a couple, it's $20,000 each in your returns, regardless of what other income you may have. So you just need to make sure you're reporting exactly in line with that ownership percentage.
And on smartpropertyinvestment.com.au, we love a list. It's how people like to consume content. And I'll close out with this question, Adam, because I think we've covered a lot of ground and people might be starting to go, oh, this is getting a bit heavy. But give us 4 of your top tips that you can share with investors on how to be a better property investor.
Yeah, look, the 4 key things for everyone listening. One is include all your income. So any income you receive, so not just through your property manager that's leasing your property out, but if you're using those online platforms, even things, if you've had damage to your property or the tenants have damaged the property in some way and you've received an insurance payout, that needs to be reported as a source of income for your property. So make sure you report all that income as part of your return, or you're providing that to your agent. Get your expenses right. So for that, make sure you're eligible to claim those expenses. So ensure that it's for the period that your property was actually rented or available for rent. It wasn't when you first purchased it and those sort of things. So make sure you're actually eligible to claim it. Make sure you can claim it for that year in full. So if you renovate a bathroom, you can't claim all of that in one go. That needs to be spread over a number of years. So consider when you're allowed to claim it. And finally, that apportionment issue. So not only on your ownership percentage, but also on for how long the property was rented. My third tip, and maybe it should have been the first one, because I think this is the most important one, and it's the one we often see people falling down, and that's keep all your records. It's really important to keep your records and keep a bit of a running tally or diary of what's happening with the property. Mm-hmm. So when you're buying the property, your contracts, your loan documents, all those sort of things. If you're making repairs to the property, your receipts from your builder, your plumber. If you're going to put an extension on, make sure you've got that all documented, what it was, the cost, everything like that. By keeping those really solid records and actually, keeping just diary notes to yourself about what it is, what was the expense, why did you do what you've done, why did you let a tenant not rent the property, or whatever the situation is, keeping those records so that when you sit down to do your tax return or you sit down with your agent, you can provide that to them in full and say, look, this is what I'm doing, these are all my records, this is what it means, and it makes it a really simple, straightforward process to complete the return. Without those records, you've got no hope.
I completely agree with you. And if this is one thing you take away from this podcast is document it when it happens, diarise it as well. So you can actually, I need to leave myself clues everywhere to know why I did a particular thing. So I make sure it's written down. And, as I've gone through my journey as a property investor, we now have a pretty sizable portfolio. And when you start adding in a lot of properties and a lot of different things are happening, if you do not have a system and process for mapping and documenting and registering and housing and recording, it's different for every single person, but you need your own central system or tools or repository of information well structured to get this right, because then tax time is a breeze. Yep. And if you dread tax time, that's fine. You need to get that right. But to put that in the utility of being a better property investor, you need all this information anyway. If you want to buy a new house, the bank's going to ask you for it. So you're best off doing it now. So that means when your accountant asks for the information, you just send them a USB stick with all the information well set out and formulated, and you shouldn't have to answer any questions. It should be a nice, easy, smooth process.
No,
that's my view.
Exactly. And I fully support the view. If people learn one thing from the discussion today, keeping their records and keeping them regularly, I think that'd be a fantastic outcome.
It removes so much pain and stress.
Yeah.
And it's also an enabler to the point of like being able to get mortgage finance easy if you've got all this stuff. But anyway, move on. So what's your last tip there?
And really my final tip, you're in the investment market, capital gains applies in this market. So as soon as you're using property to invest in, even if your priorities are around trying to gain rental income or all those sort of things, or a bit of side income for the short-term renting out the room, as soon as you do that, capital gains is in play and it will apply as soon as you sell that property. So your obligations don't finish as soon as you've sold the property. You still have more after the fact.
So what we're talking here is paying the tax on the value increase of your property at a point in time that you realise that. So if you never sell your property, you'd never pay CGT. But at a point in time, you will sell your property, or it may transition title, whether it's to do with estate planning. There is always a CGT event.
There'll be a CGT event on that property at some point in time.
Yeah.
There will be.
Well, as property investors, I don't know many property investors that don't invest in property not for the purpose of wealth creation. So there is the component of wealth creation. It will be realised at a point in time, and you've got to pay your tax at that point in time. But there is some nice discounts around it, though, which are in place around it, around CGTs.
Yeah, so the default discount, 50% discount.
Yeah, pretty reasonable.
On any gain. Yeah. So it's not a bad free kick, so to speak.
Yeah.
And there's also a new program where if you invest in affordable community housing, that discount actually increases to 60% as well. So those that are looking at, providing affordable housing to the community, there's an actual added incentive there if you go down that path.
And this goes back to one of the reasons for some investors to invest is being able to provide housing for people. So I think it's a really good initiative. I really enjoy the chat, Adam. It's encouraging to hear directly from the ATO their attitude and philosophy towards working effectively with property investors to get the best outcome for everyone. So it's good to hear that.
Oh, thank you very much for the opportunity, and I hope everyone's learnt a little bit, and I look forward to coming back in the near future and answering everyone's questions.
Yeah, well, I'm sure there's always questions around tax. All you need to do is smartpropertyinvestment.com.au. Wherever you listen to this podcast right now, press that start recording button, send it through, and we'll put them all together. I imagine we'll probably get a lot of similar questions, so we'll make sure we can cover as much ground as possible. Or if you want to email the team directly, it'll go through to Emma Ryan, who is our editor on Smart Property Investment. It's editor@smartpropertyinvestment.com.au. If you like these discussions around taxation as one component of the property investment, we'll concentrate a lot more. Just let us know what you think. If you're not subscribing yet to our daily morning newsletter, so the first to know what's happening in property investment and taxation right across the nation, smartpropertyinvestment.com.au/subscribe. Social media, Smart Property HQ. You can also follow the tax office on social media, no doubt. I'd just search tax office. I think, is that what it is, Adam? Probably, yeah.
Yeah, so ATO, Twitter and Facebook, LinkedIn.
All over it.
Yep.
And that's how you can get, I know you're doing a lot more updates these days. Actually got that press release, I think, from the ATO when there was that conviction around that person who was flipping properties and not paying CGT. So it's good that you're down this pathway of information and education, and we'll continue to share any updates that happens from the ATO on smartpropertyinvestment.com.au. Adam, thanks again for coming in, mate, making a trip up from Adelaide to have a chat with us today.
All right, thank you.
We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.